So you may have heard from many financial experts that suggest that you should pay off your mortgage early, but you might be asking, why pay off your mortgage early or faster when you can take any excess cash and savings and put it into investments such as stocks, bonds, ETFs, mutual funds, you name it. Or you might be an individual with 2.5%, 3%, 3.5% low fixed rate mortgage, and you're thinking to yourself, well, why pay this off? Because this is practically free money with inflation hovering around 2.5% to 3%. But as a financial expert myself for many years, I've seen a lot of homeowners overlook these two facts and scenarios that they miss out on when it comes to making a decision whether they want to pay off their mortgage early or to invest any excess cash or savings they have. Now, don't get me wrong, I'm not anti-investing or I'm not anti-paying off your mortgage early. I simply want to state scenarios and facts that a lot of people don't consider when making the decision. I am 100% for investing, and also I'm 100% for paying off your debt early. But as you know, it's about how to best optimize for your financial goals and your scenario. So here in this video, I'm gonna go and dive into the two lesser known scenarios and facts that a lot of homeowners miss out on. I personally think because they overlook or miss out on this information, this is costing them potentially thousands and years in addition to their 30-year mortgage. So let's dive right in. Now, what I'm about to share with you is simply my interpretation and illustration of what I believe is happening to many homeowners. They're overlooking these facts and it's contributing to massive costs and delay when it comes to paying down their mortgage. And if you are a homeowner with 2.5%, 3%, 3.5% low fixed rate mortgage, I'm gonna show you why you're not necessarily safe either. And of course, if you have a 6, 7, 8% interest rate, obviously there's more motivation to pay it off because you're gonna be paying massive amounts of interest over time. Now, what you're seeing on the screen is something called an amortization chart. This chart basically depicts how much interest and principal you're paying on a given period of time when it comes to your payments. So let me break this down a little bit. The line that goes from left to right represents the amount of time you spend paying down your mortgage. So for most of you that have a 30-year mortgage, here you have your 0-year mark, and over here is your 30-year mark. So as you get closer to the right side of the chart, you're getting closer and closer to paying down your mortgage. Now, the line that goes up and down, the y-axis, represents the amount of your payment every single month. So some of you have $1,000, $2,000, $3,000 of principal and interest payment. Now, speaking of principal and interest, we have principal and interest also depicted on the chart, as you can see, based on the two distinct highlighted area. Now, in the very beginning portion of your mortgage, in your first 5 to 10 years of your mortgage, you'll notice that vast majority of your monthly payment, your principal and interest, is going towards interest. So if you actually take a look at your mortgage statement or truth in lending statement, you'll notice that vast majority of your payments in the first 5 to 10 years, majority of it proportionally is going towards interest. And that's because it's simply math. The principal balance is at its highest. Therefore, the interest accrual is also at its highest as well. And the biggest mistake I see from homeowners when it comes to understanding this concept is that they have this belief that interest is paid linearly, meaning that they think they're paying equal amount of interest every single year, which is simply not true, mathematically speaking. So all that to say, first 5 to 10 years, vast majority of your payment is going towards interest. And this, of course, at the end profits the bank. But here's where most homeowners don't necessarily think about, and that's the question of when will you move next? And most homeowners, and because we're all humans, we can't predict the future. I mean, heck, I don't even know what I'm gonna eat tomorrow. And because we fall into this fallacy that next year is gonna be the same as this year in terms of our living situation, this is where most homeowners don't think about. Now, for this illustration, I'm gonna draw a line around the 6 to 7 year mark on your mortgage. And this 6 to 7 year mark is very, very important, and I'll share exactly why. According to the US Census Bureau data, the ACS data back in 2007, the average US adult here in the United States move about 11.7 times in our lifetime. Now, of course, this is just an average. Some of you may move more, some of you may move less. But by taking the average data given to us by the US Census Bureau data, now if we would interpret this data by assuming that we will live to be about 80 years old, well, 80 divided by 11.7 gives us roughly around 6 to 7 year mark. So all things being equal, most American homeowners could expect that they can move every 6 to 7 year mark. So let's come back to the chart for a sec. I drew a line at the 6 to 7 year mark for a reason. And the reason why I drew the red line on that 6 to 7 year mark is to depict the average time frame when an American family is expected to move. So here's what's interesting. We talked about how the first 5 to 10 years of your mortgage, vast majority of your payments is going towards where? To the interest. Well, let's say in 5 to 6 years, you decide for various reasons, you need to sell your house and move because maybe you have a new job, maybe you need to move across town, maybe you move out of the state. Anything could happen There are varying life circumstances that obviously gives us no choice but to move and sell our house. So what happens when we list our house, sell it, buy a brand new home across town, get a brand new mortgage? The question is, do you get to continue making this progress you've made beyond this 5 to 6 year mark to where you're getting closer to paying more principal with each of your payments? Or do you have to start all over? Well, if you answered you had to start all over, you're absolutely correct. If you get a brand new 30-year mortgage because you moved and bought a new home, you have to start all over back to square one, where vast majority of your mortgage payment is yet again proportionally going more towards interest. In other words, you're back to a spot where vast majority of your monthly payment, your mortgage payment, is not going towards principal, but vast majority of it is going towards interest. So if you now have a 2.5%, 3.5% fixed rate mortgage, you never know what could happen in your life in the next 5 to 7 years that can pretty much force you to make a decision that you have to sell and move. And this is definitely one of the big contributing factor as to why there's not enough housing supply right now, because a lot of homeowners don't want to lose their 2.5%, 3%, 3.5% fixed rate interest that they got back in 2020, 2021. And if you're on the other side of the spectrum where you got your mortgage in 2023, 2024, where obviously your mortgage rate would have been at 7 or 8%, then obviously you have more of the motivation. This illustration is going to look a little more intense for you because that first 5 to 10 years on an 8% mortgage, nearly all of your payments is probably going towards interest. And of course, I would encourage you to take a look at your mortgage statement to see what's actually happening to your payments. The other scenario that's relatively common is that even if you were not to move, well, there's a scenario where next year, 2024, 2025, at least at the time of this recording, the Federal Reserve may lower the interest rate, which means that some of the banks may also lower their mortgage rates as well. And that could potentially lead to a wave of homeowners that bought in 2023 and 2024 to go back to refinance. Well, if that were to happen, same scenario, they basically make it to year 2 or year 3 of their mortgage. And if they get a brand new 30-year refinanced mortgage, they start all over back to square one. Even though they may have refinanced to a lower rate, they're back to the spot where vast majority of their payment is yet again going towards interest. So I'm painting an illustration here where there's two scenarios. One is you decide to sell your house, get a brand new mortgage, start all over. Scenario number 2 is obviously refinancing to a quote unquote lower rate. But in reality, the total interest payment has increased because now you prolonged and further delayed the maturity of your mortgage. So if you are a homeowner, you might be in a fork in the road situation where you're having to decide, do I want to pay off my mortgage or do I want to aggressively invest into my retirement, my 401k, my brokerage account, whatever the case might be. Now, I'm not here to tell you to do either. I simply want to state the facts or at least present you with information that maybe you haven't really thought about before when it comes to social economic behavior and how that impacts overall when it comes to finances. And sadly, not many financial experts are talking about this. And to many, it's not a factor or a variable that they're thinking about when making a financial decision. So with that said, whether you have a high interest rate mortgage right now, 6, 7, 8% because you just got your mortgage, or you're at a low 2, 3, 4% fixed rate mortgage, I'm here to tell you that it's definitely in the realm of possibility that you may not have that 2, 3, 4% interest rate for long. In 5 to 7 years, you could be in a scenario where you have to sell your house and get a brand new mortgage, potentially even at a higher rate. Now, my personal opinion, my perspective is that I believe all homeowners should stride towards at least paying off their mortgage faster to save money and time so that they can ultimately not only experience financial peace of mind, but to also focus on their retirement, the investing, and etc. And I know there's many of you that might disagree with me, but if you at least consider the factors and the information I shared today, but it does make sense to at least consider the idea of paying off your mortgage earlier and why that could be a more pressing or urgent issue than you thought. So if you're watching this and you had a massive aha moment, let us know in the comment section below and share this with your friend or family member that owns a home. And if you're wondering, how do I then pay off my mortgage early? What is a better way? Is it just sending extra payments or is it doing bi-weekly payments every month? What is the best way to do this? Now, I personally teach a strategy where we want to help you pay off your mortgage in as early as 5 to 7 years using a banking strategy that comes from Australia. And if you want to learn more about this banking strategy where you can potentially pay off your mortgage faster, I'll go and leave the video link down below in the comment section so you can go and check that out as the next video. So with that said, we'll see you in the next video. See you there.